If you've ever tried to learn about investing, you'll often hear that it's a fool's errand to pick individual stocks. You'll never beat the market, they say. Just buy an index fund, they say. By the aggregate statistics, they are right. Most hedge funds, institutional investors, and individual investors do not beat the S&P 500 index. Even legendary investors like Warren Buffett advise that the average individual should just dollar cost average into a low-fee index fund, reinvest the dividends, hold long term, and call it a day. This is objectively great advice. You don't need to know anything about investing or pay fees to some financial advisor. It's a simple do-it-yourself strategy. For little effort, you can use the power of compound interest and build long-term wealth. That said, if you want to take a more active approach and pick individual stocks, it is actually possible to beat the market. It happens all the time. Personally, I've been beating the market throughout my short investing journey. Let me share that data. I'll start with my dividend stock portfolio, which I frequently highlight on this channel. Following that, I'll reflect on some of the lessons learned along the way. If you stick around to the end of the video, I'll share how all three of my investment accounts compare to the index. Spoiler alert, I beat the market to an even greater degree over a longer time horizon. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoy the video. On my brokerage, Merrill, they have a feature which tracks the time-weighted return of your investments. This measurement helps remove the distorting effects created by inflows and outflows of money at certain times. This feature also allows you to compare your portfolio to equivalently investing in indexes such as the S&P 500. My highest value brokerage account, which follows a dividend growth investing strategy, has been beating the S&P 500 over the past 3 years. During that period, the dividend portfolio has a 38.34% time-weighted total return. This is compared to the S&P 500 total return of 33.45%. These measurements include the impact of reinvested dividends. Overall, I've been beating the market with a 5% gain over the index. In that same time period, my dividend portfolio crushed the NASDAQ Composite, which only had a 16.15% total return. This was mainly due to a horrific 2022 with interest rate increases not seen in decades, causing valuations to plummet among unprofitable tech companies. I avoid these types of companies in my portfolio, hence the outperformance. This highlights a key part of my investing criteria, which focuses on highly profitable businesses. I'll discuss that more later. Currently, my dividend growth stock portfolio has 13 total stocks. It has been a massive learning experience, and the holdings have evolved a lot over time. Every month I share an update for this portfolio here on YouTube, dating all the way back to May 2020. Dividend Data viewers have watched this account grow from $30,000 to now $148,000. They've seen all the lessons learned along the way, and believe me, there have been a lot. First off, this return would actually be far, far higher if some key mistakes were avoided. Avoiding mistakes is just as important as finding the next great buy. My viewers are familiar with many of these, whether it was AT&T, Intel, Disney, Walgreens, etc. Behind each of these errors, there are themes from which you can learn from and avoid in the future. For example, a key lesson I've learned is to avoid capital-intensive, low-growth, or declining businesses. These are companies which require massive amounts of capital investment just to stay in business, not even to fund growth. AT&T is a prime example of this type of business. Also, Intel falls in that category with how expensive building semiconductor manufacturing plants really is. Intel spent $25 billion in capital expenditures last year, far exceeding their operating cash flow. Walgreens has become that type of business as their cash flow collapsed over the past 2 years. It is far more difficult for these types of businesses to generate outsized free cash flow. This means they are not able to reward shareholders with growing dividend payments and share repurchases. In fact, each of the stocks I just mentioned saw their dividend payments get cut dramatically. Other lessons include avoiding unprofitable companies which trade at a high valuation. These companies got crushed during 2022 with the interest rate increases. Countless stocks are down 90% from their highs, barely having recovered. Even companies like Twilio with promising long-term businesses got demolished. In a bullish market environment like that caused by zero interest rate policy, a company's financial strength will often be neglected. All that many cared about was top-line revenue growth, especially businesses which came from the venture capital world. Profitability was an afterthought at best. This is not reality though. As Warren Buffett says, a rising rising tide floats all boats. Only when the tide goes out do you discover who's been swimming naked. In 2022, there were a lot of businesses caught swimming naked. Profitability isn't just an option, it's a must. It's the bare minimum to create a sustainable business. Luckily, my preference for dividend-paying stocks helped me avoid these types of companies. However, one slipped through: Disney. I got sucked up by the top-line subscriber and revenue growth in their streaming business. I overpaid significantly at a premium valuation. However, this was unprofitable growth. Disney increased spending on content dramatically, far outpacing their monetization. This caused streaming losses to expand, peaking in 2022 at negative $1.5 billion a quarter. Since streaming is the core future of Disney's business, it caused their valuation to plummet. This was a lesson learned. Avoid money-losing companies trading at a high valuation. These are just a couple of ways that I've learned to avoid killer investment mistakes, which will drag down your total return. As I've continued learning, I've gotten far more selective with my stock picks. When I started my dividend portfolio, I had over 50 individual stocks. I followed what could be best described as a scattershot approach. I blindly bought up everything during the 2020 market crash. With this high number of stocks, it becomes far too difficult for a beginner to intelligently understand and value the businesses they are investing in. Since 2020, I've continually reduced my number of stocks, often going far larger into my best ideas. This is a strategy I learned from studying Charlie Munger and Warren Buffett. You don't need to have 50 big ideas at once. It's unreasonable to even think that. You don't even need 10. You should wait and focus on your best investment ideas and go big. I've found this to ring true in my own investing experience. Within my dividend portfolio, ExxonMobil and Microsoft were some of my best performing investments. I bought Exxon during the oil crash of 2020 and it was obvious to me. I thought I went big at the time, but I should have gone even bigger. I'm up 187%. I bought Microsoft in fall 2022. I knew this was a high quality company set up for long-term growth. It was trading at a fair price. I went big. It became my top holding, but my mistake was not going even bigger. I'm now up over 60% in a little over a year. I'm planning to hold this for the next decade. In my personal experience, the largest returns come from my best ideas. This becomes obvious when we look at the overall return across all my accounts. This includes investments made before my dividend account. It is only across 3 stocks, and the overwhelming majority of my return comes from one, Tesla. My older Tesla investment has a 1,300% return, and the more recent one from January 2023 is up 87%. These helped fuel me to beat the market. Since December 2017, my investments have a 114.62% time-weighted return. In that same time, the S&P 500 has a total return of 98.3%. Over the past 5 years, my investments have a time-weighted return of 129.77%. That is compared to the S&P 500 with a 107.75% return. So I'm beating the market by 20%. Over the past 3 years, my investments slightly underperformed the index with a 30.96% return compared to 33.35%. So by now you should understand that it's absolutely possible to beat the market over the long term. That said, you won't beat it every day, month, or year. If you're going to invest in individual stocks, you have to develop your own intellectual process and trust your judgment. Don't blindly listen to others or pick the hot stock of the day. You can use others' analysis as data, but you need to focus on your own process. I am far, far smarter about investing now than I was 5 years ago. I think this will lead to even greater success in the market moving forward. Still, many of you will ask, why even try to beat the market? Why even bother picking individual stocks? As I mentioned at the beginning, you can do great just dollar cost averaging into the index. There is nothing wrong with that strategy. However, I actually enjoy the intellectual process of investing. It's a game you can play forever. I'm already investing for my financial future anyway, so why not be more engaged in the process? I have learned a lot. It helps me understand more about business and the entire economy around me. The education has been invaluable. If you want to follow my investing journey, journey, then subscribe to the channel and watch my portfolio updates. I don't take any advertiser money on these videos. Instead, let me tell you about the stock research tool that I've developed, dividenddata.com. I've shown this periodically throughout the video. Here you can analyze individual stocks with every financial metric you need to understand a business. I built the tool to help me find better investments and avoid money-losing stocks. The data visualizations easily let you understand the financial strength of a business. This is vital if you're going to pick individual stocks. You can save stocks to your watch list and wait for dips in price so you can pounce on the opportunity. On top of this, there are calculators to estimate the intrinsic value of a stock. If the software helps you identify just one better investment, then it pays for itself. Here you also gain access to my portfolio tracker, which provides unique insights for the dividend-focused investor. Becoming a member of dividenddata.com is the best way to support the channel. Thanks for watching.